All right. Hello, everyone. I see we've got some familiar faces and some new faces. So, as usual, I just want to open up the meeting to again say that we are very happy to see so many folks participating with our learning sessions, and we really hope that it's valuable. And as always, we hope that what you capture here, you take to others. And you may not be able to tell them everything, but you at least will spark their interest, because as we're doing this year of learning sessions, we hope to continue to do them or even double them forward, knowing that we are providing needed information specifically to shared ownership owners. But sometimes with a session like today, we like to invite anyone that is a homeowner, because whether you're a shared ownership homeowner or you are a single family homeowner, the information that John has for us, don't even try to call him Mr. Groene, he'll tell you that's his dad. So the information that John will be providing to us is somewhat curtailed, but it is across the board if your property is identified as single family. And so, again, really appreciate everyone's attendance. If there is anything else that of curious knowledge that you may have, or you want to affirm something that you know, please let us know. It is really the success of these sessions is out of all the information Dana has collected from your requests for assistance, from your inquiries about regulations and responsibilities. And so we realized that a lot of people was looking for some of the same information. And if I always say, I represent 1 out of 100 to 1,000. So if it's new and informative to me, I try to think about who else do I know that it may be informative for as well. So with no further ado, because John's presentation also puts you to work, with no further ado, let me have John tell you a little bit about his background and how he's come to do this workshop for so many years.
All right.
John?
Good afternoon, everybody. And I'll be ping-ponging with Dana Wallace as well as we're going through this. But so my name's John Groene, and the self-defense, the financial self-defense workshop is really born out of my last 25 years working with homeowners here in Chicago, and especially the last 15 working on the West Side, and learning from those homeowners about the costs that they're facing as homeowners. Buying a home is certainly very important. It's and all the support from, housing agencies, to help people do that is important. But what I really fell in love with was helping homeowners stay in their home. You'll hear in the public, discourse, people saying, "Oh, I'm going to buy some properties cheap and in foreclosure," like that's a good thing. Well, I think that's an awful thing when someone loses their homes to foreclosure. And so really, financial work, self-defense is about helping homeowners understand and save as much money on all their housing costs as they can, so they can build their savings and ultimately, own their home for 30 or more years. And so, that's kind of how it came about. All right. Dana, anything else, or should we go ahead and get started?
I was wondering if Miss Easter is on the call with us.
Yes, I am.
Hi, Miss Easter.
It's nice sharing Dana so we can see her.
Oh yeah.
No, I'm not putting myself on camera. I'm someplace where I don't want to be on camera. Okay.
No problem.
Okay.
No problem.
Okay.
I can talk, but not on camera. So Let me go. Hi, my name is Millette Easter. I am the president of the Drexel House and Garden Association. John came to our complex, had a meeting with several of the homeowners there, and he gave us some very, very, very important and strategic information, mainly the cost that a lot of us were paying for our electric and gas bills. And I've always felt that, why am I paying this much? And he had sat down, explained it to everybody. He had me contact the individuals uh, that I had the bill with, and miraculously, I contacted them, I changed it, and both my gas and my light bill has dropped dramatically. And I think that is so important because your gas and your lights and your water bill, that's a big chunk of your money also. You pay rent or insurance or whatever, but when you have to pay uh, a $500 light bill and all the charges, extra charges they put on, it takes a hit on your income. So myself, I was so glad that he gave us that information because I just kept who I had. And I always thought it was odd that for my lifetime, you had People's Gas and Commonwealth Edison. And if you look on your bill, as he had us look, you got another entity that's saying, okay, well, we're going to be the service people and we're going to charge you. And I'm like, well, it's coming from the same place, but he explained it. And so, like I said, my greatest thing was that both of my bills, the lights and the gas, have dropped dramatically. So I do appreciate you, John. You don't know how much. When I got that first bill from the last bill before I talked to you and I looked at it, I'm like, this is a significant difference in what I'm paying. And there's other people in the complex. They're not on here today, I don't think, but I didn't see their names, but they also did it. And one young lady did it before me, and she was so happy. She came down to my house telling me, tell that man I said thank you. She couldn't remember your name, but she said, tell that man I said thank you. So that's my take on how important it is for people to get the information. Because if you don't get the information, if somebody doesn't present it to you, then, you stay in limbo until you know. And it's a lot of things that we should know that we don't know. So again, thank you, John. I appreciate it.
My pleasure, Miss
And
Eaton.
all right.
Thank you, Miss Easter, for your testimonial, and I hope everybody heard Miss Easter and takes heed to John's tips and tricks tonight.
Right.
And all of this will be recorded and shared with you guys after the meeting as well. And we'll give you the link to be able to do so. So with no further ado, John, you can take it away.
All right. If we can share that main screen, let's take a look. Okay. So, managing the cost of home ownership. If we can go ahead and go to the next slide. All right. So, as homeowners, there's certain costs that you have to pay, from your mortgage, but for 90% of us, included in that mortgage is also property insurance, property taxes. And if we're a homeowner, we have to pay a gas bill, an electric bill, and a water bill. And so as I accompanied homeowners on the west side of Chicago, we started seeing what the average costs of things were, because we were working with probably about 250 homeowners a year, we started seeing the average costs, and then we started seeing costs that were way out of line with what we saw as the average cost, and we started to ask why, and then we started to do things about it. So all of these learnings came from working with homeowners, where we would work, once a month for an hour and follow up the next month and follow up the next month until we knew that everybody's costs were in line. So the mortgage, most homeowners are pretty sophisticated about interest rates. And, over the last 15 years, that didn't seem to be the biggest issue facing homeowners. A lot of the homeowners I worked with had fixed rate mortgages at 3 and 4 and 5%. We weren't seeing the predatory lending that we did, in the early 2000s and 2010s, where you're seeing 9 and 10 and 12%. No, I was mostly seeing 3 and 4%. But the struggles that the homeowners were facing were from the other parts of their mortgage payment. So let's go to the next screen. All right. So if we have a mortgage, for most of us, insurance is required by our lender. You have to have homeowners insurance. And once again, for 90% of that, that is part of our mortgage. Okay. And so I think insurance companies they absolutely love that we all have escrow accounts, because it's very easy to go on autopilot. And I would have folks, come to me and go, "Oh man, I want to change mortgage companies because my mortgage payment went up, and it was supposed to be a fixed rate mortgage." And we'd look closer and it had nothing. The principal and interest hadn't gone up, not even a penny. It was how much they were paying either for taxes or insurance. Okay. So as we started looking at homeowners insurance, we started seeing average costs and average ways to, the best ways to save money. Okay. By far, the biggest discounts you'll see in insurance are the home auto insurance, the bundle, the home auto discount, and then the claim record discount are by far the two biggest discounts you'll see. Of course, another, way to lower your premium is raising your deductible. But let's go to the next page, because I love teaching with horror stories to show you the impact this can have on your mortgage. Okay. So I talked about average cost we see. So for single family homes, for the longest time, we'd see an average cost if you have the home auto discount and you haven't made a claim in the last 3 years, we'd see about $1,200. Now, since the pandemic, we're seeing those prices go up a bit, but $1,200 to $1,600. On 2-unit buildings, between $2,000 and $2,500. But what would happen is we'd be looking at someone's mortgage and we would see something way out of line with that amount. So the example I have here was, this is the son brought in his father saying, "Hey, I don't think my dad can afford the house anymore since mom passed, because he's only making $1,800 a month in Social Security, and his mortgage payments is almost $1,100. So you see in the lower left-hand corner there, his payment was nearly $1,100 a month. You see that $1,088. Okay. But in the upper right-hand corner, you'll see it was a good mortgage. It was a 3% fixed rate mortgage. There was nothing wrong with that mortgage. He was actually paying less than $375 a month for the borrowed money itself at 3%. Okay. But we asked him to bring in his homeowners insurance into the meeting, and he's like, "Oh, well, the mortgage company pays it." I'm like, "Yes, they pay it, but it's we who decide whether it's when you first bought your house or, a few years after. We decide who insures our house." But he brought in one of his end of the year statements, and very quickly we honed into, if you look really closely there at the bottom right hand there on C that Dana has it listed, The previous year, he had paid $5,967 for his homeowner's insurance. And at the time, the average cost was about $1,200. And so we went through all the questions. I said, okay, have you had a claim in the last 3 years? That might explain why you're paying so much. He's like, no, John, I don't think I've made a claim in 10 years, if ever. I'm like, okay. Tell me about your house. You don't have like a hole in your roof, an active leak or broken windows or crumbling stairs, because, if we comparison shop and change, the new insurance company is going to send someone out to make sure the house is in good enough condition. He's like, no, it's not perfect, but no, we're okay. And so we simply did is we said, okay, let's get quotes from 2 other insurance companies on both your home and your auto. And he got 2 other quotes. So we weren't looking for less insurance. We weren't looking for less coverage. It's the same exact amount of coverage. I just want a better price. And so if you go to the next page, one of the 2 quotes he received right there, $1,211. So think about that. He was paying nearly $6,000 a year for his homeowner's insurance on his single family home. And by simply comparison shopping, he was able to get it down to $1,211. And you'll see there, I like this bill. I think this is a State Farm bill. But you could see those 2 biggest discounts right there, the home auto discount and the claim record discount. Okay, so how did that affect his payment? So if you go to the next slide, you'll see that, this is another example. Let's go back 2 slides. Oh no, it was there. It was there. Go ahead again. So in the lower left-hand corner, his mortgage payment went from $1,088 down to $555 simply because he comparison shopped his insurance. Now, the other thing I've seen people do is they'll comparison shop their insurance and then they'll say, okay, the insurance company, here's my mortgage company, send the bill to them, and then they get paid. Well, they'll forget to cancel the old policy. You have to remember to cancel the old policy. In this case, and this is another way where money comes back to the homeowner, he canceled the $6,000 a year policy after just 3 months into the policy. Remember, your mortgage company pays a whole year. Once a year, they pay a whole year of insurance. Well, he canceled it after they had insured him for only 3 months. So his prior insurance company had to send him a check for unearned premium because they didn't cover him for the full 12 months. They only covered him for 3 months. So he got a check back for $4,000. And when he first came into me, he was a couple months behind on the mortgage, or at least 1 month. So he was able to use that money to catch up on the mortgage. But think about it. We didn't refinance. We didn't touch his mortgage. We simply right-sized the cost of his insurance. Okay. The other example here on the same page, you'll see it's labeled F there. This was another homeowner whose mortgage was over $1,600 a month. But if you look closely on her principal and interest, it was a good loan. And it was, less than $550 a month, right? But over $1,000 for the escrow. When we look closer at her insurance, she was paying Farmers over $7,300 a year. Okay. And so once again, by purely comparison shopping, she was able to comparison shop. And I think the policy she got was about $1,700. And in the end, a year later, her mortgage went down to $1,029. Okay. So the cost of insurance matters, but also knowing how much is the average cost is just as important. And I think this is something that when we were meeting with Miss Easter and the folks at Drexel Townhomes, I wasn't as familiar with the average cost of insurance on these shared ownership townhomes. But what we did is we found one of the homeowners and we looked at the policy and, everything covered, not the roof, because that's a common area in this instance. He was paying about $600 a year. And another owner of another unit was paying $2,100. And we looked at it, and her policy was for a single family home. And it was even expensive for a single family home, right, at $2,100. And so she was able to comparison shop and find that. So you really want to work with other people that own units in the same complex you do and kind of come to what is the average cost people are paying, how much coverage do people have, and look at that, because unfortunately the only person that's going to look after our money is us. And when I would see these, I think on the next slide, do I have the example of all the different example? Yeah, okay. So, some people are like, okay, John, you found 2 bad cases. It's like, no, we found hundreds of cases. We actually documented savings of our homeowners over a 10-year period, and it was close to $1 million in first-year savings. So you'll see in the upper left-hand corner, that's a homeowner, that's a single-family home, and she's being charged $4,800. The upper right-hand corner, that's a 2-unit. She was being charged nearly $5,300. Bottom left, 6,053. That one was another single family home. And then there's the one where it was nearly $7,400. And so knowing what the average cost of insurance is important. And once again, starting with a single family home is somewhere between $1,200 and $1,600. So I assume if your condo policy covers, some of the common elements, it should be less than a single family home. Okay. And, when someone says, oh, John, shouldn't this be illegal? They were paying $6,000 a year when they could have only been $1,200 a year. And it's like, well, I wish it would be illegal, but they're just going to defend themselves and say, look, they asked for insurance. We gave them insurance. What did we do wrong? And so that's where knowing the average cost is important. So once again, reviewing, where do you find the average annual premium for your circumstances? That's a tough one. When we first started doing this, we looked for statistics, the state of Illinois or what's average cost. You can't find it. And so really this was just what we learned from homeowners, and we're looking at, probably about 1,000 homeowners over a 10-year period and what they were paying. And that's where we kind of came to the conclusion that single family home, $1,200 to maybe now, up to $1,600, 2-unit, about $2,000 to $2,500, and our 3 to 4 unit, $2,500 to $3,000. And that's in Chicago or Cook County is where all my experience is. That's the kind of costs we were seeing. And then once again, the one policy that we kind of looked over together during the workshop with the Drexel homeowners, the $600 a year appeared to be enough coverage and the proper coverage, not $2,100 a year. And so it is tough. Now, the only way you can really find out if you're paying too much is simple. Comparison shop. Get quotes from 2 other companies. And once again, always comparison shop your home and auto together. Okay. And compare it. And once again, you're not looking for, when you're comparison shopping, you're not looking for less coverage. You're looking for the same amount of coverage, and if you can get better pricing. Okay. So in terms of saving money on discounts, number one is claim free. In the insurance world, claim free means not having filed a claim in the last 3 years. If there was a fire, some companies will go back 5 years before they call you claim free. Okay. The other thing is, if there's damage to your home or damage to your unit, before you make a claim, before you call that 800 number, okay, because remember, you have about a year to file a claim. Number one is get a quote from a contractor, find out how much it is. Because if the contractor says, oh yeah, I can fix this for $1,200 and your deductible is $1,000, why would you file a claim for a $200 benefit? They're just going to jack your rates up because you just lost claim free. Okay. The second thing is, I always tell people, don't call after hours, call during office hours and talk to your agent. Nobody else but your agent, and saying, am I covered? And brainstorm, because the minute you call after hours to the 800 number or you call a claim line, they're going to give you a claim number. And that's going to be a claim on your record. I found cases where someone called up with a question after hours and they gave them a claim number and denied their claim in some cases because, oh, you're not covered, and their insurance rates went up. So don't even call unless you know for sure you're covered and it makes sense that you're doing the claim. And I always tell people, the small claims, don't do them. They'll get all their money back and then some with the smaller claims. And yes, you can do a higher deductible. If you have $1,000 deductible, find out how much lower your premium be if it's a $2,500 deductible or a $5,000 deductible. Now, if it only saves you $50 a year, I'd say phooey, don't, stay where you are. Don't raise your deductible because the savings isn't enough. But if they say, hey, you raise your deductible to $2,500 or $3,000, we're going to save you $300 a year, I'm listening. That's real money. So they look at your claim record. They look at, when you're comparison shopping and you're going to switch, they're going to send an inspector to look at the outside of your house. And then lastly, believe it or not, and I think most people kind of realize this, the higher your credit score, the lower your insurance premiums. The lower your credit score, the higher your premiums. Now, I think that's absolutely atrocious, but the insurance industry claims that they have data saying that people with lower credit scores make more claims, and that's how they justify charging us more. Okay, so yes, and there is a risk of switching too many times. Okay, so really what I tell people is once a year, and I don't know if this is on the next slide or the last slide, once a year, they send you a renewal notice.
Mm-hmm.
It comes from your insurance company, not your lender. Once a year, they show you a renewal notice. Well, the renewal notice makes no sense unless you get out last year's policy and compare it. Is the coverage about the same? Is the pricing about the same? Or, is it $50 more? Okay, if everything looks good, I'm good. And you do that if you're doing that every year. Now, if suddenly it goes from $1,200 up to $3,000, it's like, whoa, 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 whoa. I didn't make any claims. I didn't do anything. What's going on? I would comparison shop. So, I would say try to, stay with a company for, 3 years at a time. I think would be a good, if it's a little less or a little more, that's great. But what you're doing, and once again, our goal isn't to spend all our free time comparison shopping so we get the lowest, best deal on insurance that anybody's ever gotten. No. What we're trying to do is just keep an eye on it and make sure it's somewhere close to the average cost so that we know we're getting a fair deal for our money. Once again, your auto insurance, every 6 months, they're going to send you a renewal notice. Get out the last 6 months policy, take a look at it. Is it about the same? Did it go up? Just keep an eye on that kind of things. And once again, home and auto bundle is the biggest discount other than claim free. And then another way to check on your insurance, if you can't find your insurance policy right away, is your annual escrow analysis. And so most of the homeowners I work with, very astute at looking at their monthly statements, and they know immediately if something goes up. But a lot of times they'll forget about the once a year. So you get 12 statements a year, but you also get one other very, very important document, and that is the annual escrow analysis. And that's where it explains to you if there was a change in cost, if your taxes went up or your insurance went up, it tells you this is why we're raising your mortgage and by how much. And it's critically important to be aware of that. The other thing, mistake I've seen folks that they've comparison shopped. They found a new, better priced policy, a good value. They went ahead and switched, and they forgot to cancel their prior insurance. And I had this in a case where this is a homeowner that had been with Allstate for probably 40 years. And they finally got a little bit, too high on the premium. And we said, let's comparison shop. And he found a good value about, saving him about $1,500 a year. And he went in and switched. Well, he forgot to cancel. And the next time we met, I saw that his mortgage went up. And I'm like, wait a minute. He hadn't fixed it or he hadn't canceled the old policy. And so Allstate has a new policy that says they can only refund you going back like 30 or 60 days prior to when you call to cancel. And it had been 6 months. So in my eyes, they cheated him out of about $2,500, which I thought was dirty pool, as my dad would say. But, and we did a complaint to the Illinois Department of Insurance, and they says, oh, no, they're a private company. They can do these things. And so you want to remember that after you switch your insurance and you've passed their inspection, so by law, if they're going to do an inspection of the exterior of your house, they have to do it within the first 60 days. And once they've done it, everything's good, cancel that other policy. And they're supposed to, when you cancel, they're supposed to cancel it back to the day you have proof of new coverage. Back to the day. Because you can't do it all in one day, right? So 60 days later, you call and say, yep, I've had insurance since, what's today, March 31st. I've had insurance with this company since January 31st. I need to cancel my old policy. Well, they have to refund you back to the day you have proof of new coverage. So very, very important. And once again, the caution is always, if you have deferred maintenance, visible deferred maintenance on the outside of your house, the gutter is down, there's a broken window, there's crumbling steps, there's something that an insurance inspector would see, you got to fix that first before you comparison shop and switch. Okay. Let's see. Let's go ahead to the next.
John,
Yes.
did you touch base on, especially for share ownership folks, that they should have their broker look at what's covered under their shared ownership type, condo, co-op, townhome, so that they're not getting insurance that's already covered?
Yeah, exactly. So I think being able to look at what does the condo association's policy cover, and what does your insurance need to cover? So
Right.
if the roof is a common area, and if there's a problem with the roof, the homeowners association is going to cover that if there's damage. Then you don't need insurance on the roof. You might just need insurance on the interior of your unit. And so that's why generally insurance on shared ownership is slightly less, because you're paying it through your association fee. And that's why it's also critically to please, please, please pay your association dues, because without that, things go downhill very quickly, because those shared costs have to be paid.
And the last thing, if I may add, John, is also make sure you understand what your share or the condo co-op town had. That if something happens and you have to move out of the unit, that it's the condos or your co-ops. If it's not in their insurance policy, then no, it's not their responsibility, right? And so again, make sure you understand your bylaws and you're really, really clear about what does the policy cover. Just as you don't want to double up, you also want to make sure you know what they don't cover, so you get it if you feel it's something that's needed.
Yeah.
Okay.
Yeah, and I think, and that just going to the basics of insurance company, number one will be the building policy. You know, what would they fix on your building inside your house if there is damage, okay? But also there's personal property insurance, your personal articles. So that's for all your things. Like if there's a fire, you know, replacing the things that you lost that are not attached to your unit. So your clothes, your furniture, the artwork on the walls, all those kinds of things, that's your personal property. So you got the property coverage for the building itself and anything attached to the building. And then you have your personal property that should be covered. But there's also something that's critically important called loss of use. Okay, so your homeowner's policy should have a loss of use that says, hey, if you can't live in your house, guess what? If you can't live in your house for the 6 months when they're repairing it, you know, through the insurance claim, well, you can't live there. The mortgage company don't care. They still want their monthly mortgage payment. So loss of use, they pay for you to live elsewhere until you can move back into your unit and then resume paying, you know, your mortgage. So it makes sure that, okay, for those 6 months, the $1,000 of rent to live elsewhere is being paid through the insurance. All you're doing is continue to pay your mortgage. That's called loss of use. And so every insurance policy should have that loss of use. In addition to, there's, you know, liability insurance. And that's the insurance that if someone falls down your stairs and says, I'm going to sue you for everything you are worth, well, your insurance company will insure you into court up to the limit. Now, on single family homes, the most common amount I would see is $300,000 for personal liability insurance. I've seen 100,000 is fairly common on single family homes. A lot of times I see 300,000. And once again, that's the slip and fall. Someone falls on your property, they're going to say, this is your fault, I'm suing you. Your insurance protects you with the personal liability. All right. So, and if there's any questions you haven't been able to ask during the presentation, we could come round back and catch it at the end, but we're going to go now to everybody's favorite topic in the whole wide world, property taxes. Everybody loves property taxes. We love supporting our local government. Okay. So I think most homeowners are actually more sophisticated about, oh, and I'm blanking on the term right now. When your property value goes up and then you challenge that with the Cook County assessor, it's called, why am I blanking on it? Anybody? I need help. When you appeal your assessed value.
Yeah.
So doing appeals on your assessed value. So every 3 years by law, and so you can't even get angry at Cook County assessor in this case. Every 3 years by law, they have to reassess the value of our properties by law. And so every 3 years in the mail, you will get something from Cook County assessors that says, hey, this is a reassessment year. And you know how we said back in 2022, your house was worth $100,000? Well, now it's worth $150,000. Okay. And the same time you get that notice, within weeks, you're getting notices for all these law firms that specialize in doing appeals, saying, hey, you can appeal your value and you pay us 1/3, all that kind of good stuff. Okay. And you can certainly do that. And some of those law firms are very good at what they do. But I actually focus on the exemptions that are built into our property tax system that save us money. Okay. And I'm going to start out with the simplest, which is the homeowner's exemption. Okay. So the homeowner exemption, how do you know if you're getting or not? Okay. So as homeowners here in Cook County, we get 2 tax bills a year. One in the winter, and it's blue. And we usually get it in February, and our mortgage company pays it by March 1st. And then we get the yellow one that, apart from the years during the pandemic, always seems to come out around 4th of July weekend, and it's due by August 1st. Okay. The blue bill that comes out in the winter, who cares? Don't worry about it. There's no good information on it other than this is what you pay, and you only worry if you get a reminder notice saying it wasn't paid. Then you got to call your lender, right? It's the yellow bill that comes out in the summer that you should look very closely at every single year. Okay. And so we're going to zoom into on the bottom of this yellow bill. So this is the second installment bill that comes in the summertime. We're going to look at the bottom right in the middle. And right there, it says 2018 total tax before exemptions. In this case, the homeowner's taxes were $5,478. Okay, that's their property taxes. In this case, it was based on a value of $277,000. But right below that is the homeowner exemption. And it's been pretty in Cook County, well, mostly in the city of Chicago, it's usually been right around there, $679, $609, somewhere around $700. It's a discount. And it's a discount only for the home you live in. It's for your principal residence. Okay? So if you own 2 properties and you say, oh, my husband lives at one and I live in the other, we should get the homeowner. No. Only on your principal resident, 1 property. Okay? But I came across dozens and dozens of homeowners that I looked at their bill and they weren't even getting their homeowner's exemption. Why is that? For most of us, if you bought your home from another homeowner, you don't have to do anything. The discount just stays with the property. You don't even know why you get that $700 a year discount. Okay? Don't have to do anything. But if you bought your home from an investor who had been renting out that property, after you've lived in your home for a full year, you have to apply for the homeowner exemption. And once again, it's about a $700 a year discount. And once you have it, you don't have to apply for it again. Now, every year when I get my yellow bill, what do? I look to make sure I'm getting my homeowner's exemption. And I've, owned my home now for 11 years. Every year I still look, am I getting my homeowner's exemption? Okay. In this case, they're getting it. Okay. Next slide would be, okay, so we talked about, there it is. So here's a slightly newer bill, but you'll see here to the left, the homeowner exemption right there, $701.60. Okay. And once again, once you sign up for it the first time, or if you never even had to sign up because you bought from another homeowner, once you have it, you don't have to file for it every year. It's a simple discount. Investors who have rental properties, say an investor owns 10 rental properties. I'm going to look at all 10 of his rental properties to make sure he's getting 0 homeowners exemption. That's not for investors. It's for homeowner occupants. It's for your principal residence. Okay. And once again, once you have it, I would check the bill every year to make sure it's still there, but you don't have to sign up year after year for that. Okay. And for most of us, that's all we have to worry about. But eventually, we're going to turn 65. Okay. And in Cook County, there is an additional discount for when you turn 65. Now, actually, Cook County will say, no, it's not when you turn 65. We're doing it by the year you're born. So this year, anybody born in 1959 can apply for the senior exemption for the very first time at, Cook County Assessor's Office, or you can go to Cook County Assessor's Office, and all you have to do is be born in 1959 and live in the property. And that's another $550, $560 discount. Okay, very important. Now, you have to know to do this yourself because Cook County claims that they do not know when someone turns 65. Okay, do I believe that? I don't know. When I turned 50, the AARP people sent me a birthday card before my wife or children did. But be that as it may, you have to know to sign up for this. Okay. And once again, the senior exemption, you only have to apply for once, and you can make $1 million a year. You can make $300,000 a year. You can make $1 billion. It has nothing to do with your income. It has to do with your age. Okay. So once you sign up for the senior citizen exemption, once again, I would check it every year when the yellow bill comes out to make sure I keep getting it, but that's all you have to do. Okay. And you see in this case, it's like, okay, this person's house was worth $120,000. His taxes started off at about $2,500, a little over $2,500. After his discounts, his taxes for the year are only $1,200, $1,300. Okay. And that's for a senior homeowner. Okay. Now, there's one more, and this last one is the most important one, and it is not the senior exemption, it is the senior freeze. The senior exemption, you'll see in this one, on the example I was just looking at, it said senior freeze 0. And the reason it said senior freeze 0 is that homeowner was earning more than $65,000 a year. His household income was over $65,000, so he couldn't get the senior freeze. Okay. If your income is below $65,000, you can also apply and have to apply each and every year. I've heard hundreds of times people, oh, no, someone told me that I don't have to, the senior exemption, I only have to apply for that once, right? No, the senior exemption, well, that's true, but the senior exemption is not the senior freeze. The senior freeze is the one program you have to apply for each and every year if your household income is below $65,000. And every year, once you do it for the first time, they're going to send you an application in the mail right about now. If there's any seniors on the call right now, you probably just got one of the senior freeze applications. Okay. And the beauty of the senior freeze, so if you look to the left there, people go, John, why do you spend all this time saving someone $218 a year? Don't you have something better to do with your time? I says, you don't understand how it works. Because what they're doing is they're freezing your assessed value. Okay, doesn't make a big difference the first year. So in this case, his property was worth just under 120,000, and his senior freeze is only $218 a year. That's nothing, right? But think about it. 3 years later, when his value goes up to 350,000, and everybody else's taxes go up, and I mean everybody else's taxes go up, and everybody else should think at least consider appealing and fighting for, wait, it's not really, except for those with the senior freeze. For the senior freeze, it doesn't matter. You never appeal your assessed value if you already have, if you're getting the senior freeze every year and you're applying for it every year, and suddenly they say, oh, congratulations, your house is no longer worth 150,000, it's worth 1.5 million. As long as you're applying for the senior freeze, you say, I don't care. It doesn't matter. They've frozen your assessed value going back to the first year you received it. And you'll see a case here right beside it. Here's a senior that's been getting the senior freeze for 15 years. And that senior freeze that started off at a discount of $218 is now nearly $4,000. Okay? And so I live in Cook County, and I know I don't get the senior freeze. I'm not a senior yet. I'm right around the corner. I'm 58. I'm no spring chicken. But I know my taxes are slightly higher because of programs like the senior freeze. And I am fine with that. I think it's wonderful because I can think of nothing worse than, oh, you invested in your property, you invested your time and effort in the local park and the local schools and the block clubs, and now you can't afford to stay in the home that you've lived in for 40 years because in retirement your income's low? Well, that's not fair. So the senior freeze you have to apply for every single year based on your household income. And where do you find that income? Your tax return. This year, everybody thinks this year, if you're applying for the first year, they want to know what you made in 2024. No, they're going back 1 year further. It's always the year before. So they want to know what you made in 2023. And if it's less than 65,000, you apply for it, you fill it out, you sign it, keep a copy, send it in. Check the bill when it comes. Let's see, a couple questions. What should a cooperative do when senior shareholders file for the senior citizen exemption? Can it retain the exemption for the cooperative, or should it be paid to the shareholder? So my understanding of property tax bills is no matter if you're in a condo association, a homeowners association, doesn't matter. Everybody has their own property taxes. And so you've got a PIN number. If you have a PIN number, the PIN number describes what you own, you're paying taxes on that PIN number. And if there are discounts on your property taxes, yes, all of these apply. All of these apply.
So John, as long as, because cooperatives have that one PIN, right? So as long as there's a PIN, there's an exemption for that PIN.
Yes.
Okay.
Now, I have to back that up. In terms of cooperatives, I'm at a first grade level. I have a very rudimentary understanding of cooperatives. Now, homeowners association, condo associations, it's exactly the same. Single family home, condo association, homeowners association, everybody's got a PIN, everybody pays taxes, and there are exemptions, these discounts built into the system. For the cooperatives, we're going to have to find an expert.
Right. That's what I was going to say, John. For the cooperative, let me get confirmation, but um, it's really not an exemption for the shareholders. It's an exemption for the corporation. And so the question is it considered a corporation that does housing versus housing units like condos? And so let us get you definitive information for cooperatives, so that we're giving you how Cook County looks at cooperatives.
Yeah. Yeah. And I think, you know, I was making fun of Cook County Assessor's Office not knowing when someone turns 65. I think Cook County Assessor's Office does a wonderful job at this. And they actually, and one of the participants added this in, they're more generous than almost any other county in the state of Illinois. They allow you to do a certificate of error. In other words, oh, I made a mistake. I didn't get my exemption, my senior exemption, my senior freeze, my homeowner exemption. You can apply for a certificate of error going back up to 4 years. In most other counties, you can only go back 1 year. And it's kind of, you know, use it or lose it. And yes, I've had folks that came in and they bought their home 7 years ago, and I'm looking at their tax bill and there's no homeowner exemption. I'm like, okay, we can apply to get you back that money going back 4 years, but you lose those other 3 years because, you snooze, you lose kind of a thing. And so, but very important, if you have your own individual PIN, you've got your own individual tax bill, these exemptions are critical. And please, if you're not yet 65, you probably have a parent or an aunt or an uncle who is more than 65, and they'll say, oh yeah, I'm getting all my discounts. No, they're not. Many times they're not. And the only way you can tell for sure is looking at that yellow bill right down there in the middle. Are they getting their homeowner exemption? Are they getting their senior exemption? And if their income's below 65,000 a year, are they getting their senior freeze? Okay, critically important. You know, when we talk about foreclosure, you know, I worked for Neighborhood Housing Services of Chicago for 26 years. And, you know, a good deal of our housing counselors' time was spent in foreclosure prevention. And when someone falls behind their mortgage, most people assume that, oh, someone passed or someone lost their job. That's why they fell behind their mortgage. I see most times what's happening is people forget to do their senior freeze, or they're not watching their cost of insurance, and their insurance skyrockets, and they have a shortage in their escrow, all these kinds of things that cause people to fall behind. So this is critically important to every year look at your renewal notice on your insurance. Every year, look at the yellow tax bill to make sure that you're getting all your exemption you deserve. Critically important because it impacts your mortgage. All right. Next slide.
John,
Yes.
I wanted just to also add with condos and sometimes townhome associations, they do it together. Like the HOA will hire a lawyer to do it together, and each owner pays a portion of the fee. And I will tell you, I've been doing this for now 20 years in the condo that I live. Other than 2 years, we've always gotten money back.
Yep. Yeah. And so, and this is not, what Janae is saying is right. You know, I remember I once appealed my home's value all on my own because I said, oh yeah, you can do this stuff. You don't have to pay the lawyers. And so I did it. I did the research. I found 3 like properties that were very similar to mine that were paying less in taxes, and I submitted it, and they said, nope, Mr. Groene, we're right, you're wrong, denied. And I didn't know what to do. And so these law firms, they know what they're doing. and they will appeal your value and find out if you're overassessed and lower it back down. That's a good thing. And if your condo association is doing that every year, that's a good thing. But the exemptions are totally separate from that. The exemptions are simply the discounts that you receive as a homeowner or as a senior homeowner on your PIN, regardless of the property taxes overall. So yes, is it a bad thing to appeal? It is absolutely not. Okay. But for homeowners, you want to pay attention to those exemptions, those discounts built in the system. And here's an example that Dana's got set up for you where there's a tax bill where this is a homeowner that came in to see me and they weren't getting nothing. Zero homeowner exemption, zero senior citizen exemption, zero, nothing. Okay. Now, if this is an investor who owns this 2-unit property and they're renting it out, that's what it should be. There should be no. But if this is a homeowner, there should be at least a homeowner exemption. So this is what you don't want to see on your parents' tax bill or your aunt's or uncle's tax bill or your tax bill if this is the home you live in. All right. And you can do a certificate of error for missing exemptions, these missing discounts going up to 4 years here in Cook County. All right. If there's no questions, and once again, we can all stay on as long as we need to. If there's questions at the end, let's go to the next slide. Oh, here's some final thoughts on this. Once again, yes, we get 12 monthly mortgage statements, but you also got a yearly escrow analysis once a year, and you want to look at, is there a shortage in my escrow? Is my payment going to go up? And you always have to remember, if your property taxes go from $3,000 to $6,000, most people assume, oh, my mortgage will go up $250. Just divide 3,000 by 12. Well, no, you got to remember that your mortgage company just spent a whole year under collecting, and now your taxes are 6,000. They paid the 6,000 last year, even though you didn't have enough money. You've got a shortage. Your payment's going to go up to $500 for that first year. So a shortage is they under collected for a year. They want the money back. And if you don't have the money to pay it all at once, they're going to basically stretch it out over a year. But that first year is tough. And I've seen people's mortgage go up, $800 a month for a full year until the next year it goes back down to only 400 more. So be very aware. Next slide. Okay. And this is what Miss Easter was talking about. Okay. So in the state of Illinois, about 15 years ago, they deregulated the supply of energy. Okay. In the city of Chicago, there's only one regulated supplier of electricity. That is ComEd. In the city of Chicago, there's only one regulated supplier of gas. That's People's Gas. Okay. So they have to get their rates approved by the Illinois Commerce Commission, right? But you can choose from dozens of companies if you like that say, hey, buy your supply of gas or you supply it from us, we'll charge you less. Okay, buyer beware. So the first thing I always talk about is there's a not-for-profit out there, and you'd see advertisements in your ComEd bill. It's called Citizens Utility Board, or CUB. They're a not-for-profit, and what they do is they focus on gas, electric, and water. Okay, so and I'm going to come back to the water discounts, but let's go to the next screen because I want to teach from horror stories that I've encountered. Okay, so here's a homeowner who came in to see me, and I said, oh, do you know that you have an alternative supplier? He says, what? No, I get my electricity from ComEd. No. So look at the big circle in the middle of this bill. Okay. To the right of the big circle, it says ComEd delivers electricity to your home. That never changes. ComEd owns the wires. If there's a storm in the middle of the night, they got to come out in the middle of the night and fix that. That doesn't change. I've never seen a bill in the city of Chicago that doesn't say ComEd delivers electricity to your home. Can't happen. That's not going to change. But to the left of the big circle, it says who your supplier is. Okay. And in this case, I pointed out to the homeowner, did you know that your supplier is Green Mountain Energy? And I can't remember, the homeowner's like, oh yeah, I think maybe I signed up. They said they'd save me money or they'd buy from Green, but okay, fine. But when you look at the second page, and right there under R, Dana's got highlighted there, it says Green Mountain Energy, and it says how much they were charging this homeowner. And so in the bottom right-hand corner, it says ComEd, price to compare. So by law, and this is thanks to the current Attorney General, Kwame Raoul, passed a law that says, very simple law that says, you got to have this sentence on the ComEd bills. And right here it says, the ComEd electric supply price to compare is 6.473 cents per kilowatt hour. Okay? So that is the regulated cost in this point in time. This is a 2020 bill. Okay? So we look over at Green Mountain Energy in this example, they were charging him 15.4 cents per hour. Okay? So they were charging him more than double the regulated rate. Okay? So what do you do? You actually, to cancel, you have to call up not ComEd, but going back to the left of the big green circle, the 800 number for the company. There's always an 800 number underneath the name. You call them and you tell them, hey, I would like to cancel and go back to ComEd for my supplier. And I recommend you also say, and please, could I have a confirmation number confirming my cancellation? Okay. Because yes, I had homeowners that said, John, I canceled 6 months ago and I'm still with them. It's like, nope, you need the confirmation number. Okay. Now, the person you're calling works for that company and they're trained to say things like, oh, do you really want to do this? It's going to take 2 or 3 months. I mean, this is a big head. I want to cancel and go back to ComEd. And I see homeowners smiling. So I guarantee you there's people on this call that went through this with me or on their own. I've also heard them say, oh, you're going to miss out on all these great benefits, such as, does your gas smell better? Does you, what it's gas. What? Okay. So if you go to, but they're going to say all kinds of things to convince you to stay. And what I say, nope, I'd like to. Now, there's also a history of, and this is a homeowner, they're like, John, they told me that I had to switch, that I could not stay with ComEd or I could not stay with the rate. No, that's absolutely not true. You can use any one of these companies or you can stay with the regulated supplier. So if we go to the next screen, what we did is we simply calculated. I said, okay, if you had used the same amount of energy and you were paying the regulated price, your bill would have been $92 and you paid $219. So they charged you $127 more in 1 month. Now, we were on the insurance and property tax thing going back to like 2015. We were right on it. We saw it. But for years we're like, oh, gas and electric, what, at $2 more, $2 less, who cares? It's not. When we started seeing $127 more for the same, oh, no. So he called and canceled, and we would actually monitor it each month until he went back. And so the next month, once again, charged 15.4 when the regulated rate's 6.5. He paid $117 too much. And then the next month, you'll see if we switch to the next screen, hopefully it'll show a ComEd bill with ComEd as and there it is. So you see the difference. To the left of the big circle, it says ComEd provides your energy. Okay. And I tell people, you haven't been switched back until you see it says ComEd provides your energy. Okay. We found hundreds of these cases on the west side. Out of those hundreds of cases with people with alternative suppliers for gas and electric, I found one person who had an alternative supplier who was being charged less than the regulated rate out of hundreds. One. Okay. So, buyer beware. Next slide. Here's the gas. So in the gas bill, they did not pass legislation that says you have to put the regulated rate on the gas bill. So how do you tell? The easiest way to tell is if you have people's gas, you shouldn't have a second page. If you have a second page in the upper right-hand corner, and right here it's labeled U2, you'll see the name of another company. So that alerted me that this person had an alternative supplier. Okay. They don't have to put what their rate they're charging you. So we had to divide how much they used by the cost. And at a time when the regulated rate was 20 cents per therm, they don't call it gallons for whatever reason, they call them therms of gas, was 20 cents. They're being charged 48 cents. And then they had a junk fee of $4.95 a month. You know, one of those junk fees, those made up fees. And so in this case, it was $7.29. So once again, they're like, John, don't you have something better to do with your time than save someone $7.29 a month? Well, he called and canceled. And remember, it takes 2 months. And this was a July bill. And we don't pay much in gas during the summer. So go to the next bill. When he finally switched back, remember he was paying 48 cents plus $4.95. When he used 194 therms in the middle of winter, that saved him $44 in 1 month. And you'll see, this is how you see on the first page of the bill, if it doesn't say gas charge, that one little line is missing that you know you have an alternative supplier. It's easier to just look at the second page. If you got the name of another company, you've been switched over. But in this case, $44. I remember this, it was early in 2024. Someone referred, it was a board member, referred a homeowner living next door to her saying, John, she didn't get her senior freeze. She's in her 80s. Her taxes tripled, you know, can you help do a certificate error? Yeah, no problem. Sat down with her and her daughter. I'm like, okay, you know, you got to do this every year. So he filled out the paperwork, did it. I said, did you bring your gas and electric bills per chance? Like, oh yeah. And I looked at it. She had an alternative supplier that charged her $1,200 more in just the 3 months of that winter. $1,200. And then we looked at the daughter's bill. She lives elsewhere. She had one too. So when we thought that, oh, this is no. This is serious money. And so if you're going to switch and go to an alternative supplier, keep your eye on what the regulated rates are. You got to study it. You got to be good at it, because if you're asleep at the wheel, they'll take you. Okay, so once again, People's Gas is the only regulated supplier of heating gas in the city of Chicago, and ComEd is the only regulated supplier of electricity in the city of Chicago. If you want to know what the rates are right now, and my examples on ComEd, I think were from like 2020. I think the rate is still right around there, 6.5 cents per hour. But citizensutilityboard.org, another good not-for-profit, they'll show you what the regulated rate of ComEd is, what's the regulated rate of People's Gas for in the suburbs, what the regulated rate of NICOR is, or, you know, if there's another company that's a regular supplier. But you've got to watch this, and you don't have to switch. You can stay with the regulated player, or you can switch and try to save money, but buyer beware. And then lastly, this is for seniors more than anything else, but the water bill. So the water bill, this is where if anybody wants to lead a movement, so there was an article came out in Crane's Monthly, Crane's Business, where it talked about the Attorney General passing this law saying you got to put the regulated rate of ComEd on every ComEd bill. And they did it, right? But in that article, on the second page of that article, it basically said, the business model these firms employ relies on their customers not noticing they're paying too much until months or even years go by. That's led to more than 1 million households, just in Illinois, buying from retail suppliers, they're only talking about electricity in this case, to collectively pay more than $100 million above what they would have with ComEd in each of the past 2 years. That's $200 million more that these companies are charging us. And this is a 2018 article. And I thought, oh, well, they're done. They're going to change it. Everything's going to change. Well, we're in 2025 and nothing's changed. So if anybody is good at leading mass movements, I'll march with you. I'll be right there with you. I won't throw chairs through windows and stuff, but I'll march. But yeah, it's still happening. So please, friends, families, neighbors, the easiest thing is starting with the ComEd bill. Just look to the left of that big circle. If it says another company, you got to do a little math or get them to call Citizens Utility Board. All right. Water. And then we're getting close to wrapping things up, and I'll leave you all alone to enjoy the rest of your evening. So in the city, there is a senior sewer service charge exemption. Okay. So on your water bill in the city of Chicago, there is a water charge. Let's say it's $50. There's also a sewer charge. You know what it's going to be? It's going to be $50. If your water charge is $75, your sewer charge is going to be $75. If your sewer charges, or if your water charge is 40, sewer charge 40. You all get it, right? They're basically saying if you use $50 worth of water, you're using $50, you're flushing $50 down the pipes too. And then there's the garbage fee. Okay. So water fee, sewer fee, there's a water sewer tax based on that total, and then a garbage fee, that's your bill. Once you're 65, you could do this on your birthday. I wouldn't do it on your birthday. Do the day after, a couple days after. You apply for this. It's only for single family homes. And I would include a single family, shared unit condominium. You sign up for it once, has nothing to do with your income. Only has to do with, do you live here and are you 65? You fill out this application and it eliminates your sewer charge. So if your sewer charge was 20, if your water charge was 25, your sewer charge was 25, it eliminates that $25 and it cuts the water sewer tax in half. So I'd see with single family homeowners, they were saving $60 a month. This is a one-time application. Okay. The only other way to save on the water bill is the utility billing relief program. Okay. Really smart program that was set up during Mayor Lightfoot's administration. And it says, if you own a single family home or a 2-unit or now a 3-unit, they've included. Okay. And you're income eligible for LIHEAP. If you go to SEED every year and are found income eligible for LIHEAP, help with your gas and electric, you also can apply for a discount on your water bill. And it's the same exact discount as if you're a senior and you get the senior sewer service charge exemption from the city of Chicago. But you have to apply every year on your anniversary month, every single year. So every year, all I tell people, you're already going to CETA for LIHEAP. All you're doing is bringing one more document. Instead of just your ID and your proof of income and your gas and electric, also bring your water bill. Okay? Because the city relies on CETA to tell them if someone's income eligible. And if they're income eligible, CETA can help you sign up to get a discount on the water bill as well. Another great program a lot of people don't know about. All right. And then summary. I think we're close to this. Oh, there's the LIHEAP. Gives you an idea of the, for a family of two, that's $3,400 a year times, that's like 38,000. I mean, yes, it bumps a lot of people out, but even a single person, if they're making less than 30,000 a year, they're eligible for LIHEAP and then hence the utility billing relief. And you see these notices on water bills every year. So I'm telling you, if you're eligible and go every year to CETA and you're income eligible for CETA for LIHEAP, bring your water bill. You can also help save money on the water bill. Very important. All right, so this is the two things out of my summary that I always do is interest rate does matter. And all those commercials say, bad credit, no problem, we got you. The faster the loan is, the easier it is, I guarantee you the higher the interest rate. And interest rate does matter. If you look at a 5-year car loan at 5% and you borrow $25,000, with 60 easy payments, you're repaying $28,300. So you borrow $25,000, you repay $28,300. If you bought that same car with an 18% car loan, $25,000, that's 60 easy payments of $634, you're repaying $38,000. The difference is nearly $10,000. So it's not enough to have good credit in this world. You have to know you have good credit, and you have to know what interest rate, when you get a car loan or a house loan, it entitles you to. Because if you leave it up to them, I guarantee you, they're going to jack the rate up. And once again, the rainy day fund, our grandparents told us to do it. Our parents might have told us to do it. And it used to be 12,000. And 12,000 if the homeowners association owns the roof. The reason I pushed it up for single family homeowners to 25,000 is the cost of roofs has gone up so much. But if you don't have to save for the cost of the roof, 12,000 is what I say to people to have in your savings account at all times. Okay? And you can't tell the whole family. You can only tell one person in the family that you trust. Okay? Because if the whole family knows that you have $12,000 sitting in a savings account, what's going to happen? They're going to come a begging and a borrowing. Yeah. And then you find out they took a nice trip somewhere. Don't tell. It's nobody's business. Your emergency savings is nobody's business except your own and one other person that you trust. $12,000 should be enough. And this is unexpected repair, unexpected bill, a unexpected shortage in your escrow to give you time to get through that one, tough year. 12,000 should be enough, but single family homeowners, unfortunately, I'm recommending 25,000 because of the cost of roofs this time. And that's it. So, if there's no other questions, I'm going to turn it back to Dana because she set up a really cool thing where we're going to do a virtual office hour, and then we're going to do this presentation again in a couple months.
Yes.
But I'm going to hand that off to Dana for that part.
All right. Thanks, John. We appreciate your presentation and all your awesome tips. After this presentation, everybody, you'll get a nice list of all the tips that John talked about today. So you can go and check them off and make sure you're keeping track of all of those things, the annual checkup, and also keeping that rainy day fund to yourself and one other person. All right, so the office hours, if you need to leave, that's fine. We're going to be recording this. This is just the closeout. So we appreciate everybody coming and engaging with us this evening and getting some tips. The office hours is if you
Dana,
decide that
on
you
my
want.
screen.
Oh, yeah.
Yeah, the presentation for today is over. Dana's going to be talking about the follow-up sessions.
Yeah, so on April 28th from 5:30 to 8, and if you RSVP'd for this session, you'll get this information again in email. On April 28th from 5:30 to 8, John will be coming on to this exact same Zoom, and he'll be here to answer any personal questions per person. So you can come on, get a little extra time with John himself, and if you have any bills or tax exemption questions specifically for John, you can come in and have some time with him to get those specific questions answered. So on April 28th from 5:30 to 8, that's another Monday, we'll be in this exact same Zoom taking questions and putting others in breakout rooms to have private sessions with John. So keep that on your calendar. I'll be sending more information about that as well. And then we will be doing the session again in May. And so if you missed this one, or you have some more questions, we can also come back in May and I'll send you guys information on that as well soon. So thanks everybody for coming. We appreciate your time. And I really hope you got something out of this. All of the information shared will be on the link tree.
Thank you so much.
Thanks everybody. So
Bye-bye.
keep an
Good
eye out for
night.
those emails.
Thank you.
Thank you, everybody.
Bye-bye.
Thanks everybody.